So good morning, welcome and thank you for joining this edition of our On Top of Tax webinar series. I'm Ollie Pumphrey and I'm a corporate tax partner in the South East. Today we'll be providing you with the key deadlines you need to be aware of and in-depth insights into hot tax topics. We'll wrap up today's session with a short Q&A, so do please feel free to drop your questions into the Q&A box, which you should find at the bottom of your Zoom screen. In the event that we do run out of time, don't worry, all questions are being captured and we'll follow up with you afterwards. And further point of housekeeping, the slides will be shared afterwards. You will find some links in there for follow-up, and there's no need to take extensive notes based off the slides. I'm delighted to be joined today by James Eggett, who'll be discussing the senior accounting rules by Daisy Borflower with an update on the Centrica case. Lewis will be diving into benefits in kind or nursery places. And finally, Parallel will be focusing on VAT on private school fees. So before I hand over to James, just wanted to touch on some key corporate tax compliance dates. The first there, just at the end of this month, the 30th of September, is the Senior Accounting Officer reporting deadline for PLCs who have a 31st of March year end, and for other companies with a 31st of December year end. Then 1st of October is the annual corporation tax payment deadline for small companies. That's those with profits of under 1.5 million. And a couple of weeks later, on the 14th of October, is HMRC's Form CT61 deadline, and that relates to payment of tax due on payments of royalties and interest in the quarter to the 30th of September. So without further ado, I'll hand straight over to James to discuss the Senior Accounting Officer rules. James.
Thank you, Oliver, and hello, everyone. Thank you very much for dialing in today. So by way of background, my name is James Eggett. I lead up our tax assurance and risk management team at BDO. There's about 3 or 4 partners in that team, and we specialize in supporting businesses in their tax operations. So really about your processes, your controls, your governance, the operationalizing of tax, really. And today it's my lucky job to talk a little bit and remind you about the Senior Accounting Officer rules, which has been in for quite a while, but are continuing to be quite focused on by HMRC, as we'll talk through. But I always start with this slide. I quite like this slide because it sort of goes back many years. So depending on where you are in your career, you might remember some of them. I definitely remember CTSA coming in 99, 98. And what we know in the UK, and it's quite interesting because I do travel around globally quite a lot, but in the UK specifically, the UK tax authorities have been very proactive. Government's been very proactive in a historic and continuing focus on ensuring corporates especially are able to demonstrate good tax governance, strong tax risk management, and are transparent about their tax affairs. And there've been a lot of pieces of UK legislation and regulation that have been introduced over the years, which you can see there, which reinforce this need for enhanced governance. And essentially what it was, or what it is it's requiring businesses and individuals to take accountability over your tax processes and controls. So a lot of those you're probably familiar with, depending on the size of your business. You've got everything there from SEO, which we'll talk about, but hits the larger business, and CCO, which is the corporate criminal offences, which is the prevention and facilitation of tax evasion, which has no de minimis. So hopefully you're all looking at that as well. BRR, we'll look at that as well, the business risk review. And of course, there's other things around transparency, from uncertain tax treatments there to making tax digital, to Pillar 1, Pillar 2, which no doubt are the forefront of some of your minds too. So that's a bit of the background, but let's just focus on SEO if we can go to the next slide. So many of you are probably already very familiar with this, so please bear with me. But as a reminder, this was introduced back in 2009. And I do remember it being introduced because I'm quite old and I remember that being introduced. And I remember thinking, what is this? Is this like Sarbanes-Oxley for tax? What is this piece of legislation? It had some weird words around tax accounting arrangements in it. And it was about understanding what it is. But put simply, for larger businesses, and essentially what that means is if you're in a UK group, or if you're in a group and the total aggregate turnover for UK incorporated entities is greater than 200 million or 2 billion on your balance sheet, there's some subtleties around that, but essentially that's it. So if you're on a group which has got more than 200 million turnover, you fall with this legislation. And what it requires is, first of all, for you to appoint someone in the business who can be the senior accounting officer, like an individual. And that person essentially has oversight of the UK tax operations, usually the FD or the CFO. And that person every year, as it says there on the slide, has to sign a document, an SAO certificate, and the company has to send in an SAO notification stating clearly whether or not the business had appropriate tax accounting arrangements during the year. Failing to do that results in a penalty. So you can get a penalty for not sending in a certificate, get a penalty for not sending in a notification, and you can also get a penalty for not having appropriate tax accounting arrangements. And just to make it very clear at the moment, when we talk about tax accounting arrangements, we're actually talking about the processes and controls you have in place for ensuring that the numbers that go in the tax returns are accurate. So it's more about your tax compliance processes and risks, not really about what goes into the accounts or provisions. It's about the end-to-end process for the numbers that hit the tax returns. And it's all of them, really. I mean, there are some taxes which aren't in scope, but generally speaking, we think about corporate tax, indirect taxes, employment taxes, IPT, if that's relevant for you. And there's other taxes listed on the top right there. But most businesses, their most material taxes are around corporate tax, indirect taxes, employment taxes, and there's one big one, customs as well. And we'll talk about that a little bit because customs is something that is really being focused on and keeps coming up now as part of SEO reviews. So if we move on to the next slide a little bit, and this takes me back. This, I don't know how many of you are familiar with this, what's in the screen there. This is a document which was issued by HMRC quite a while ago now, but I still use it very much to set out what HMRC's expectations are in terms of what businesses need to do for SEO. So you will get the slides later, and hopefully, if some of you are watching this on your phones, you haven't got a chance, but if you're watching it on your screen, you might be able to zoom in or we'll share that later. But essentially, there's some interesting bits there where it says responsibilities of the business. And it does say the SEO should evidence the way the business manages tax risk as part of the overall approach to risk. And this, remember, is in relation to the tax accounting arrangements or the processes for the tax returns. And it's got there, I think, bullet point, what is it there? Number 3, properly communicating tax governance procedures covering all relevant UK tax and duty liabilities. And the next one says, monitoring key UK tax risks throughout the year. So that's quite interesting. That's what's saying what the SEO should do. It's all about being aware of the risks in relation to your underlying processes and controls and being able to demonstrate that. So HMRC will expect the senior accounting officer, remember the CFO, the FD usually, supported by the head of tax if there's a head of tax, to be able to demonstrate that you have thought about the risks in your end-to-end processes for all taxes during the year. And then come to a decision about whether or not they were appropriate. And we'll talk about that a little bit in terms of what that means. But essentially, in my experience, what we find is that around a quarter, maybe 25 to 30% of certificates for SEO are qualified. So what does that mean? That means out of all the certificates going in, there are disclosure items in the certificate saying that the tax accounting arrangements were not appropriate. So it's not unusual for that to happen. And a lot of businesses use the SAO certificate to bring things to HMRC's attention, or sometimes actually to demonstrate that known issues, so voluntary disclosures that have already been shared with HMRC, have or are being dealt with. So often it's a way of being transparent and open with HMRC. So what I'd like to do now is just talk a little bit about recent updates, and then we can drill in a little bit more into the kind of disclosures that we see. So next slide, please. So this is interesting. So this is only 2 or 3 years old, but even though the legislation has been in place since 2009, there is quite a lot of activity. HMRC do talk about SEO a lot to our clients, and we are aware of various penalties. I think to date, there have been well over 1,000. I haven't checked recently. We need to speak to HMRC, but we tend to see them every year. But there's been around 1,000 penalties. And a lot of those are in relation to just straightforward failures, where businesses forget to submit SEO certificates, don't realize they fall within. But also we've seen a lot of penalties in relation to what we call sort of omissions or errors in the SEO certificate itself. So if you're not aware of the Castle Law case, it's an interesting one to look up. The Castle Law case was all about a business that forgot to include a dormant company in their SEO certificate, because you've got to list all the entities that are in scope, and dormant companies are included. And the outcome of the Castle Law case was there was a lot of commentary about the level of discretion HMRC are giving in relation to issuing penalties. And the overall response from HMRC on that was now they are giving greater discretion in terms of administrative failures, and they are actually focusing more on the nature of what's in the certificate. To what extent are your tax accounting arrangements appropriate? And if they are not, are you disclosing them adequately within the certificate? So that's why we are seeing an increasing challenge on unqualified certificates. So if HMRC have evidence that there have been voluntary disclosures or errors in your tax compliance, then they would expect to see that in your certificate, and they will expect you to have undertaken some work to demonstrate that. So this leads to the disclosures again. So I did mention that about 25 to 30% of them certificates do tend to have qualification issues. And what you might be interested in is what we tend to see they are in. So we know that increasingly we've seen a lot of disclosures around export and customs. So where we have lack of export evidence or issues around customs, that comes up quite a lot. We're seeing continually disclosures around IR35, off-payroll labor. We're seeing disclosures around non-resident directors, so a bit of global mobility there. And continuous, as always, are VAT errors. So often, if there's a problem in your VAT process, often they could be systemic, maybe a technology error, maybe something to do with VAT not being recorded on a particular transaction. That comes up over and over again. But to cut a long story short, tends to be VAT, employment taxes, and customs where those disclosures are. Okay, so I'm going to move on to the next slide. I'm being chased already. You can tell I've only got 2 or 3 minutes, but it's fine. I can follow up. So I think also what I wanted to share was a little bit on what our clients are doing, what in our conversations with businesses they are doing in terms of demonstrating reasonable steps. And very simply, if you're the SEO, you need to be able to document and evidence that you've walked through the risks and controls for each process. Some businesses do process maps. Some businesses do a risk register of the typical controls that are in place and look at your controls that manage those risks and how they've changed or how effective have they been in that year. Other businesses now are taking more of a benchmark approach. And so we sometimes help them with that, where we sort of benchmark their processes and their governance across what we would consider to be good practice and leading practice, just to give that level of assurance that there are reasonable process is in place. And being able to have that on your metaphorical shelf in case of an SEO or questions on SEO by HMRC or business risk review is important. So that leads me properly to my final slide, where I just want to bring it all together. So I did mention BRR. The Business Risk Review Plus was introduced in October 2019, and my personal view is that this is a lot better. The BRR has been around for a long, long time, if you've ever been subject to it. The BRR Plus introduced much more objective criteria on whether or not you're low risk, moderate high, etc. And what's interesting and why I've brought this in today is because SEO is a massive part of the internal governance risk factors. And so there are 8 low risk factors for each of those behavioral headings. And under governance, it says you need to be able to demonstrate you have appropriate tax accounting arrangements. So that's SEO. And it also says that you've fulfilled its obligations regarding SEO. So if you're not able to evidence the fact that you've looked at your SEO procedures and that you've taken reasonable steps during the course of the year to consider your tax risks and controls in relation to that, then you are not able to get a low risk rating according to the new BRR criteria. So it all falls into place. And if I had another 10 minutes, I'll definitely talk about CCO and the various other sort of tax strategy and other sets of guidance that's come in. But hopefully that's a bit of a reminder more than anything else on SEO. And thank you for your time. And I'll hand over more or less on time to Daisy. Thank you, Daisy.
Thanks, James. I think next slide, as this is still one of James's slides. Thanks. Good morning, everyone. Hello. My name's Daisy Bortflower. I'm a partner in our corporate international tax team in London, and today I'm going to be giving us a bit of a case law update, looking at what we think is a really interesting recent case that went all the way to the Supreme Court in July. And the taxpayer here was Centrica, hence we're referring to this as the Centrica case. And this really delved into what's been a long-standing question of, are legal and professional fees that are incurred on transactions, are they deductible for corporation tax purposes? And when we talk about transaction fees, we're talking about the fees that you might incur in relation to acquisitions of companies, disposals of companies. And we're hoping this will be relevant for lots of you, either because you've just gone through a transaction and have incurred some chunky costs, or you have a transaction on the horizon and expect to be incurring these types of fees. So if we go on to the next slide. Just to, again, to give a bit of background on what we mean by these kind of transaction fees, or sometimes they're called deal fees. These could be anything from the analyst fees that you incur in going through a transaction, legal fees, the due diligence fees, whether that's finance, tax, legal, HR, tax advisory fees for any structuring, investment brokerage fees, and also some of the smaller costs such as data room fees. What the Centrica case has done has really thrown the spotlight back onto this long-standing question of what's deductible, what's not deductible for corporation tax. And in doing so, I think it's really important that everyone notes the distinction between if these fees are incurred by a trading company or if they're fees that are incurred by an investment holding company. For trading company, the position is a bit more straightforward. Fees are only ever deductible if they're A, wholly and exclusively incurred for the purposes of that trade, and B, the fees are not considered to be capital in nature. Given that trading companies would not typically engage in M&A activity for their trade, it's normally a more straightforward conclusion to reach that these types of professional fees are not deductible. But for holding companies, the position has always been a lot less black and white and open to debate. And it comes down to whether these fees would be deductible expenses of management. And if we go on to the next slide, Just this is kind of covering a few, what I'd say are kind of key techie principles. So in terms of legislative framework for these expenses of management, so whereas commonly for a trading company, expenses will be trading expenses, trading losses, and for investment holding companies, there's obviously not a trade, but the UK tax legislation provides for a different category of expenses, which are quite simply called expenses of management. And they will be incurred if they're expenses of a company's investment business. So if a company is actively carrying on a business of holding and managing investments, it should be able to claim deductions for the costs it incurs in doing so. And most typically, these will be expenses such as any management salaries, director fees, if there's a head office, the insurance and the office rent for those, for that head office, and also things like audit and routine tax compliance fees. They're the typical expenses of management that we see as deductions. And they're the costs that are incurred in running that investment management business. In terms of what counts as a deductible expense of management, it needs to be incurred in having that investment management business. The investments themselves cannot be held for an unallowable purpose, which means they can't be held for a purpose that's for non-commercial and for tax reasons. And the key condition as well, which is this final one here in bold, is that you cannot get a deduction for management expenses if they are of a capital nature. And that brings us on to the issue, which is I think the heart of the Centrica case, is what do we mean by expenses that are of a capital nature? And if we go on to the next slide. This is not a new question. The Centrica case goes over a lot of previous case law. If just looking at this at a high level, the starting point is normally that if you're involved in an acquisition or a disposal of shares or assets, that is a capital transaction and therefore fees would be capital in nature. But previous case law that we have and what's set out in HMRC guidance to date sets out that there's a distinction between the types of cost you might incur in a transaction. And on the one hand, you have a bucket of costs that you will incur because you've had to, appraise, identify, investigate potential acquisition targets or divestment opportunities. Where there's expenditure on appraising and investigating and researching investment opportunities, there is scope to say that those are just the expenses of management, they're non-capital and therefore deductible. Whereas on the other hand, another bucket of costs are those that are specifically linked to bringing about that transaction and the implementation of a decision to acquire and dispose. So prior to the Centrica case, there had widely been considered scope to do detailed analysis for the professional fees for a transaction and be able to almost split costs into those different buckets. So a bucket where it's the researching and appraising, which could be deductible, and then the fees that are incurred further down the line. And the previous case law talked a lot about the point in time when a decision was made to acquire or dispose, and that almost became an informal dividing line between these two different types of expenditure. And if we move on to the next slide, the Centrica case itself then takes these principles further. And the basic fact pattern is Centrica were looking to dispose of a subsidiary, Oxio. They made a decision to do so in July 2009, but the sale didn't complete until 2 years later. And in that 2-year time frame, a huge amount of fees were incurred and were treated as deductible. HMRC denied the claim on 2 grounds. The first being that they didn't think the expenses were actually incurred by the Centrica subsidiary COHL, and that they were actually incurred by a different group company. And then the second challenge was that HMRC viewed these expenses as being capital in nature. There was then 4 hearings of this case through the various courts. At the first tier tribunal, no deductions were allowed because these weren't seen as expenses of management, but they were considered non-capital. At the upper tier tribunal, all was found to be deductible. These were expenses of management and they were seen as non-capital. But then at the next two rounds, at the Court of Appeal and Supreme Court, the question of whether something was an expense of management got parked, and the focus was on this question of capital. And in both hearings, the judgment was the fees were capital. And on to the next and final slide. The Supreme Court judgment has been fairly helpful, I think, and fairly clear, but still raises some questions. The question of whether something's capital or revenue is a question of law, it's a question of legal fact, and it will come down to the facts and circumstances of each disposal and the costs incurred. And it's a reminder that a lot of the well-established principles that we have to distinguish between whether something is capital or revenue still stands. And what was really important in the Centrica case in determining why the fees were considered capital is HMRC went through a lot of supporting documentation. They looked through the engagement letters of advisors, they looked through email trails, they looked through invoices, and in I think most of the instances they looked at, it was very clear that the nature of the work being undertaken was for a disposal. It wasn't for the kind of the preliminary stages, it was for bringing about a disposal. And I think in terms of what this means for you as taxpayers and us for advisors, is that it's a reminder that a likely starting point when looking at these types of costs is that they will be seen as capital in nature. That's not to say there can't be scope for certain types of costs to be deductible, but that should be subject to specific analysis. It should also be subject to the specific facts and circumstances of a company's situation and profile and the costs incurred. If deductions are going to be claimed in corporate tax computations, I think it's good to be mindful that there is a risk of challenge. The Centrica case is a good reminder that HMRC broadly sees these types of costs as capital in nature and non-deductible. And if you are looking to claim deductions, you will need the backup evidence to support that. And if there is to be an inquiry, that could mean looking at things like advisors' engagement letters. That's probably all we have time for today, but I think it's also worth noting for anyone that does have these types of costs. I've been talking about the corporate tax implications, but there are often questions around VAT recoverability too. So if you've got these types of costs, it's worth thinking about the VAT position as well as your corporate tax deductibility perspective as well. And I think that's all from me, and I'm going to pass on to Oliver, not back to Oliver and on to Lewis, who'll be talking about employment taxes.
Thanks, Daisy. And just before we hand over to Lewis, just a quick reminder, do please contribute your questions in the Q&A box. Over to you, Lewis.
Perfect. Thanks, Oliver. Hi, everyone. My name is Lewis Howarth, and I'm a Senior Manager in the Employment Tax team here at BDO in London. So just a quick roundup on some of the key compliance dates coming from an employment tax perspective. So if your business has a December year end, directors' loan accounts that may be have an outstanding balance due for payment by the end of this month. From 1st of October, so this is important if you're in the hospitality industry in particular, there's significant changes to the tips and gratuities rules. So if you haven't thought about that, you haven't got long left. And yeah, that's something key to think about. And then in October, you've got your standard RTI payroll filing deadlines. But if you also file a pay-as-you-earn settlement agreement on kind of ad hoc employee benefits, then the payment deadline for that is also 19th to the 22nd of October, depending whether you pay electronically or manually. So just some key dates there. So if we can move on to the next slide, please. Just on to the next, yeah, there we go. Perfect. So primarily I'm here today to talk to you about commercially marketed nursery schemes. So just give a little bit of context. If you're not already aware, in the tax law, there is a specific exemption that enables an employer to provide employees with a nursery space or nursery access, although there's some specific conditions attached to that. Namely, the nursery has to have the relevant registrations and approvals. I'm going to come on to the second bullet point further in a second, but effectively you have to provide the nursery to all your employees, or at least all your employees at a particular site. the employees must have kind of parental responsibility for the children, or be their own children effectively. And then there are some age restrictions to do with the children, which are attached to the registrations. Now, if we jump back to the second bullet point, when I said provide a nursery, so initially there was the rule was that the nursery had to be on premise, basically. But there was also the second carve out that something called the partnership arrangements. Now, the partnership arrangements effectively enable you to outsource to an independent nursery, which is where the commercially marketed nursery schemes come into play. But under the partnership arrangements, there's specific requirements to manage and finance the nursery or nurseries by the employer, which I'll come on to in a little bit more detail in a second. Now, the commercially marketed schemes have grown in kind of popularity of late. We're seeing many more employers look to implement them. Why is this? Well, for many employers, it's not practical to have a nursery on site. And also many more employees now work remotely, so they're not on site as much. Therefore, having the nursery on site isn't as beneficial. And probably more important than anything, there's been a significant cost increase in the cost of childcare. So this is a very attractive benefit to offer to your employees if you can make it work. Now, if we just move on to the next slide. Perfect, thank you. So I talked about the partnership arrangements, and in particular mentioned the financing and managing the nursery. So if we look at some of the conditions attached to the partnership arrangements, just under the arrangements, the scheme employer is wholly or partly responsible for financing and managing the provision of the childcare. Now, you may already know this, but a lot of these schemes are entered into by employers, and the employee opts into a salary sacrifice arrangement where they give up a proportion of their salary, and in that proportion of the salary is then used by the employer to fund the nursery place. So you may think, well, surely that's the financing part of the condition met. Well, no, effectively, HMRC has said merely paying for financing isn't met by merely paying for spaces for the children. There's an expectation from the employer to cover a proportion of the overall costs of the facility, or guarantee to cover any losses of the facility, or equally committing to pay a fixed periodical contribution to ensure financial viability of the nursery. So it's much more involved than just the employee's effective contribution to the scheme for their child. Equally, managing requires much more than you may anticipate. So effectively, you have to have say around the performance of the nursery and how they look after the children, and how the care is provided, and how they allocate spaces to children in the area that they operate. And it's not sufficient to merely just attend meetings that the nursery run and sitting on them, and that meets that requirement. You have to be able to demonstrate there's a real responsibility for decision making. Now, employers can allocate an employee who may have a child in the nursery to take on that responsibility from the management perspective, but you have to be able to demonstrate that that employee is fully empowered to make management decisions on behalf of the employer. So again, it's much more involved and can be quite complicated. The legislation around these partnership arrangements, particularly the financing and managing parts, is fairly vague. All we really have to rely on is HMRC's guidance and interpretation of those rules. The guidance isn't legally binding, but in the absence of anything else, we have to kind of consider it. And then failing that, we often look towards tax case. Now, there isn't very much in this space. In 2010, there was a first-tier tribunal ruling, not legally binding, and that very much focused on the financing aspect of the legislation. And in that case, the taxpayer was successful in arguing that they do have a real financial. Now, in that specific case, they had committed to some and redecoration and broader costs of the nursery outside of the costs allocated towards the place of the children. So, yeah, the risk with these schemes is that companies enter into them, the scheme provider comes to them and say, yeah, our scheme works, and those financing and management conditions aren't quite met. So if we just move on to the next slide, please. Perfect. So just to give you a bit of an example of why these schemes are so popular, particularly from the employee's perspective, So on the left hand, there's two calculations here. On the left hand side, the employees entered into a salary sacrifice scheme with their employer who's committed to one of these commercially marketed nursery schemes. You can see there they've got their base pay of 4,500 and they've committed 1,400 a month towards their nursery costs, which come out pre-tax. And that is fine, providing the scheme meets the relevant conditions. And you can see how that works down to their net pay of just over £2,500. On the right-hand side is somebody earning the same amount, but whose employer doesn't have one of these schemes. They're sending their child to, say, the same nursery, for instance, and their contribution towards that place of 1,400 comes out after they've been out of their net pay once they've been taxed, and it leaves them with a pay figure of just over 2,000 once they've paid the nursery fees. So there's a difference of just over £400 there. So in the employee's tax and national insurance, which is significant. And the employer in this on the left-hand side would also have some savings on Class 1 secondary NIC, and if you pay the apprenticeship levy, you'd also have savings there. And in effect, if your scheme, you may enter into a scheme, operate salary sacrifice arrangement. If HMRC came knocking at some point and challenged the validity of the scheme and how it meets the exemption, and they were successful in that argument, then effectively the employer is then deemed to have provided a benefit to the employee of the £1,400. That's per month, that times up over a year, could be multiple years. That is effectively would have been a benefit on their P11D. The employee is going to get levied with a quite heavy tax charge for possibly multiple years that they weren't expecting. And as an employee, you're going to have Class 1A NIC payments and potential interest and penalties are all tied to that. So it could be quite expensive later down the line. So if we just move to the, I think that's the final slide. So like I said, many employers are asking about these schemes. That's actually been driven for two reasons. Scheme providers are actually targeting employees, and the employees are taking it to the employers to say, can we consider this? So it kind of adds an extra level of pressure to go away and think about it and say why you might not go for the scheme. And so what we're recommending to employers is the scheme providers will have marketing and contractual documentation about their scheme. Often they'll say, yes, it meets the conditions. We'd suggest a tax analysis of that to really get into the detail and challenge what they say. There's probably something around employee communications if you're proposing to go live with one of these schemes, how it will impact their pay and some of the risks associated with it. Financial risk assessment is always valid, as I showed on the slide before with the calculations. And then in some cases, you can go to HMRC for pre-approval of a scheme. It's often quite costly, can take a lot of time. Might be something you consider if you're a large employer with a large number of employees who might take up this nursery place if it's offered by the employer. But it's something you can do. So yeah, that's just hopefully it just wraps up there. And I will pass back to Oliver.
That's great, thank you. I think another poll question has come up, so just give you a minute to read that. So we've had some good questions come in, some which are being answered live, and we'll wrap those up later. But before we come to that, I will hand over to Pam to talk about indirect tax matters.
Thank you, Oliver. So, morning, everybody. Before I move on to the topic of the introduction of that on education, private education, there are a couple of compliance dates and requirements that I thought I'd spend a couple of minutes on, largely because I think it leads back to the point that James made earlier this morning around customs and VAT issues being quite complex from a reporting requirement. So the first one of these is on the 30th of September, you'll see that the full green lane rules kick into action for goods that are moved between Great Britain and Northern Ireland. Now, what that does is provide a simplification and reduce paperwork. It's essentially a fast tracking system, but businesses do need to register in advance to be able to benefit from those. And a point to note is that some types of goods, for example, food products, will be dealt with separately under different rules. In terms of the 31st of October, there are a couple of different types of returns in addition to your normal VAT returns, of course. The first one is CBAM. For those that are aware, this relates to the carbon border adjustment mechanism, and this is about reporting on goods that are imported into the EU. So this is an EU reporting requirement, and it looks to track emissions on intensive goods, and that might include, for example, steel, cement, and fertilizers. And the requirement, one thing to note, is you have to report even if the movements are nil in any one period. So that's something to look at if it's relevant to you. Plastic packaging tax, I don't intend to cover. I mean, that's been running for a while now. The CSOP, not to be confused with CSOP, relates to the cross-border payment reporting requirements for those that provide payment services. So this applies to payment service providers, and this is about reporting around data for payments across borders. So that's required as well. The final one is a new requirement that kicks in from the 31st of October. Again, this is related to the movements of goods, and this is around the reporting of safety and security measures and this relates to goods that are brought into the UK. Now, typically you'd expect your freight forwarder to deal with these, but this is something you need to just check is being covered off for completeness. If I can move to the next slide, please. Right, in terms of independent schools, so why am I talking to you about this? I'm a director and I'm a not-for-profit specialist, so I deal with education, housing, and charities and government. So within that, I mean, you'd have to have been out of the country or hiding under a stone not to realise what was going on with the independent school. So in terms of the things I'll cover, what do the announcements cover? What's the scope of the proposals? What's the impact? And what are the next steps? And largely, we're looking at what's the impact for schools and what's the impact for parents, and potentially an impact on you if you're a private tutor or you know private tutors or working with private tutors. Next slide, please. Right. So on the 29th of July, the Chancellor confirmed formally the government's intention to implement one of their pre-election promises. At the same time, she announced specific anti-avoidance measures in relation to the change in the VAT treatment, and we saw draft legislation dealing with how the changes were going to be implemented into law. At the same time, a consultation started inviting responses from interested parties on very specific issues. Okay, now we expect the feedback from that consultation to be formally announced on the 30th of October when the budget takes place. And that's the date on which the legislation will be formally accepted. It will become live after the relevant parliamentary processes have been through. And essentially that will become chargeable on private education and vocational training with effect from the 1st of January 2025. Now, there are some exceptions and some nuances that we need to be aware of, which I'll take you through next. So if we go to the next slide, please. Right, so what is caught by the changes? So any private schools that are providing education or vocational training, and when we talk about that, we're talking about courses, instruction, education in the broader sense, they will go from being exempt from VAT as they are now to becoming subject to VAT at 20%. Okay. The other carve out from the VAT exemption are the charges for boarding and lodging. So these will also start to attract VAT. Another complication in terms of the payment of VAT is for those parents that receive special education support and are provided with support for their children that have an educational healthcare plan in place. Now, to the extent those payments are met by a local authority, fully met by a local authority, that that won't become an issue for a parent, and the local authority will be able to recover the VAT. To the extent a parent pays for part of those services and they've made a choice to send their child to a private school, when there is alternative provision in the state, at a state school, that parent will need to pay VAT on any payments that they make. Now, one of the things that I referred to was the announcement of anti-avoidance legislation. So this relates to prepayments that parents may have made in anticipation of the VAT coming in January, because we've had a long run into this in terms of announcements. What the guidance that's been issued states is, if the payment has been made before the 29th of July, then potentially that is an effective prepayment, subject to specific conditions being met. Now, if a bulk payment has been made and no reference has been made to the terms in which it covers, then the schools will need to review that, because a parent may be required to pay VAT if HMRC come in and assess that to be subject to VAT. Any payments that were made, prepayments that were made on or post the 29th of July will be subject to VAT, okay? The other anti-avoidance piece is that any supplies made by closely connected persons, subsidiaries, etc., will also be subject to the VAT being charged. And these are called both the anti-forestalling and the anti-avoidance measures. One point that I didn't raise at the beginning was, if your school is in England, then there is an announcement that the business rates relief for charities will be removed too. Now, that's not formally legislated for, and that won't be introduced until April 2025. There is a question at the moment around relief for charities, and remember, this relief applies for charities, which is about 50% of schools. They essentially will have an additional cost. But if they've got to say, if areas of the school are specifically set up for disabled students, a question arises as to whether the government will remove that relief. Now, what remains exempt is nursery fees, any goods or services that are still closely related to the provision of education. So your school meals, transport, stationery, exam fees that you pay. A key one where there's a bit of a question mark is pre and post school activities. So to the extent that parents pay for activities that are extracurricular and lead to some sort of a qualification, they're likely to be subject to that. Any sort of after school clubs that essentially provide welfare care for children, either pre or post, will remain exempt from VAT. Next slide, please. Right, so what is it that your schools should be doing at the moment? Well, a lot of them will be reviewing the liability of what they're doing. So what will be charged to VAT and what will not? And also linked to that, because they start to register for VAT, and they will be required to register for VAT, what is the net impact on fees? Because they will be entitled to recovery on their costs going forward, relevant costs, on their capital costs, either historically or going forward, and then pre-registration input tax for the last 6 months, and VAT recovery on any goods that are still on hand within the last 4 years. As I said, that some will already be registered for VAT. Those that aren't will need to register. They can register voluntarily now if they make taxable supplies, or are likely to need to wait until after the 30th of October once further guidance is issued by HMRC. The big work, though, is around systems and processes, IT systems, VAT methodologies, documentation, and implementing a process for compliance. Now, this is going to take time, and I know that one of the big pieces of feedback is this. Most schools will only have 2 months after the 30th of October, those that have not started already. Obviously, they'll need to take more consideration of those very technical areas that I discussed around were prepayments relevant, How do we treat preschool, post-school activities? What of those remain exempt? And how do we treat part-funded or fully funded education from other parties? Can I move to the last slide, please? So fundamentally, in terms of next steps, schools have got a lot to consider. The first, I mean, and there won't be absolute clarity for a while, I suspect. Post the budget on the 30th, we are expecting HMRC to issue guidance to schools. The depth and breadth of that guidance we can't comment on. We'll have to wait and see what's happened. As I said, registration will need to start to happen, and given that VAT will become applicable from the 1st of January, the first VAT return is likely to be due on the 7th of May. Earlier, and it may be earlier if the school is registered in advance. Final slide. Is there any more slides? Can we just check? So there's one polling question here for you to complete, please, before we move back to Oliver for questions.
That's great, thank you. And whilst people are completing that, we've had some questions in, so we'll start to address those. One question I've had a couple of times, whether copies of the slides will be available. Yes, along with the recording will be available after this event as well. So to turn to some of the questions that we've had come in, we've had a couple on senior accounting officer rules. So I could bring in James to start with. One question we had was whether the SEO regime applies to all companies or what the exemptions are. James.
Yeah, hi. Yeah, so that was Paul's question, I think. Hi, Paul. Thank you for your question. Yeah, the SEO guidance is pretty straightforward. Yes, it applies to all UK incorporated companies that meet certain conditions in terms of turnover. I put the answer in the chat, and the question, it looks quite clear in terms of the 200 million and the 2 billion balance sheet, 200 million for turnover, but there can be some slight complexities there. But in essence, aggregated turnover of all UK incorporated companies in your group, even if you've got an overseas parent, needs to be more than 200 million or 2 billion in the balance sheet. The guidance, I've given you a link there as well, is there. But essentially, if you are a UK incorporated company, then you fall within the regime if you meet those conditions.
Thanks, James. Whilst I've got you, on providing qualified certificates for SAO, if I haven't provided a qualified certificate before, and I'm perhaps a bit nervous about doing that, what does it mean to provide one? What happens, and what sorts of typical things might you want to submit a qualified certificate for?
Okay, that's a good question. I had a conversation with a client. I don't know if the client, hello client, if you're there on the call today, exactly that. So they've had years and years and years of unqualified certificates, and now they're thinking about putting a qualification in. Just to be clear, you don't put a qualification in just because it's been a few years, you haven't done one. The rules around qualification are quite straightforward. It has to be what they call a sort of material error, and there's all sorts of guidance around what that might mean. Not a lot of guidance on what material means, but nevertheless there is some sort of sense on it. Can't, if it's a one-off small item, but if it's something systemic or something which is material in terms of amount paid, then it tends to go in the certificate. So essentially, if you've made a voluntary disclosure to HMRC, if you're aware of something that's gone wrong in the year where it's had a material tax impact for that particular tax. So, for example, if you pay, I don't know, if the VAT payable over the year is 50 million and you've got an error of 5 million, well, that's 10%. That sounds quite material to me as an example. Then you probably need to qualify it, and you just need to think about how you qualify it. So how you describe the issue, and importantly, what steps you put in place. But there are some businesses, Oliver, which will make a disclosure about issues that HMRC are not already aware of. So for non-resident directors, for example, that I did recently for a client, that was something which was investigated. There was a potential issue. We knew that there was going to be an error that had to be disclosed to HMRC, and so I actually went in the certificate first saying, we've been reviewing the issue around non-resident directors. We think there is a potential disclosure to be made. We'll be in contact with you soon. This is what we're trying to do to fix it. So a lot of the disclosures relate to existing voluntary disclosures and things that HMRC are aware of, but something is not. But there is that concept of, is it systemic, is it material, all that's in the guidance.
That's great, thank you. We've had loads of great questions. We're unfortunately not going to be able to get through all of them, but perhaps turn to the indirect tax ones briefly. So probably a couple of the quick ones. Is there any chance that the VAT on tuition fees will extend to university fees?
I would say unlikely, because the policy is addressing private schools. There may be private universities, but I think it's unlikely to be the case. One question that may get clarified is whether the teaching of English language as a foreign, will be subject to VAT. So that's one question that may get clarified when we see the final rules.
Okay, thank you. One last one. Whilst VAT on school fees will be applicable from the 1st of January next year, is VAT recoverable on inputs incurred in the 6 months prior to that date?
Yes. So the basic rules are, if for services, 6 months prior to 6 months pre-registration. For goods, the recovery is up to 4 years as long as those goods are on hand. There are separate rules that cover up to a 10-year period for VAT incurred on capital items, so your buildings, where there's been expenditure over 250,000.
That's great, thank you. Thank you for that. Thank you to all speakers, panelists today for your contributions. That's been fantastic, very, very insightful, very interesting, and hopefully very helpful. So looking ahead, upcoming events. On the 26th of September, we have the Indirect Tax Club. It's an in-person event hosted at our London office on Baker Street to explore the opportunities and ways to avoid challenges as financial products evolve, the impact of technology on financial services VAT, and the key areas of focus for the upcoming year. Then in October, on the 8th, we have the Building Supply Chain Resilience webinar. It's a webinar offering a unique opportunity to gain insights on risk management, strengthening supplier relationships, and navigating tax issues related to customs duty and transfer pricing. On 16th of October, we have the next instalment of this webinar, focusing on the lead up to the upcoming autumn budget. Our team of tax experts will dive into the key announcement predictions across all tax areas, helping you stay ahead of the curve in navigating the potential changes. Then at the end of the month, the day after the budget, we'll be going into that in detail. We'll be joined by the Chief Executive from the Centre for Economic and Business Research to provide an in-depth analysis of the Chancellor's announcements. So whilst none of these are to miss, I'd suggest that one in particular is not one to miss. Finally, do please sign up to our monthly On Top of Tax newsletter to get a monthly roundup of the most important tax updates from BDO, plus exclusive invitations to our webinar series. For quick updates on and insights, join our On Top of Tax group on LinkedIn, where we share timely BDO news and events. And then looking on the right side, training of the month, the new customs data analytics tool, CDAT, is on hand to analyze your import and export data from HMRC, so you can identify potential risks as well as opportunities for reclaims. And finally, the SAO compliance that James has been talking about, there's a flyer there for more information and contact details. If you do not have a contact at BDO and have any tax questions, do feel free to let me know. And with that, thank you and goodbye.